we're about to have commodity price inflation. The liquidity created by the central banks, instead of going into stocks as it has been, is shifting. The river of flow is shifting into commodities. Gold has already told us that.
And so we are living through the end phase of a global credit bubble, which has been created by short-circuiting the gold and silver markets, forcing interest rates down in a secular manner over 35, 40 years. So when you have credit tightening in a credit bubble, you have the recipe for the bubble collapse.
Guys, before we begin, I just want to say this. I think what you are about to hear will likely be one of the most powerful interviews that I've ever done. We have very bright minds on the line right now. David Jensen from safehaven.com and Michael Oliver from olivermsa.com, home of Momentum Structural Analysis. Guys, we're going to describe exactly how this collapse is going to unfold. And I want to welcome both of these guys to the show. David, first you, welcome back.
Good morning, Sean. Great to be back.
Well, it's nice to have you. And the last time we spoke in our global collapse update in July, you mentioned Michael Oliver and his excellent Momentum Structural Analysis by name. And now we're lucky enough to have him here. Michael, how are you?
Oh, great to be there, Sean. Thank you for the invite.
It's great to have you, Michael. And, first let me set the stage, guys. As Peter Schiff, Mike Maloney, Bill Holter, Andy Hoffman have all recounted on this show, the biggest bubble in the world is not the stock market, it's the bond market. And the bond market bubble is ready to blow. We're going to get into it here with Michael Oliver. First, David, if you don't mind, I just want to replay this piece from our last interview in which you mentioned Michael by name. Do you mind?
No, please go ahead.
This will provide the framework. In the 80s, the introduction of unallocated gold and silver contracts short-circuited the bond market, and we're paying for that today. Listen to this.
What they did with that was they short-circuited the bond market, and by doing so, they led to this global bond bubble, which we are in right now. And Michael Oliver has done some very, very good work there at MSA. If you look up his work, it's showing that we are in a bond market blow-off phase, and he expects it to go perhaps for another month or two, and then a stepwise change in terms of increasing yields. And he's only talking about an increase in yields initially to 4%. But that can drop the value of a 30-year bond of the order of 40%. Just that small increase from the very low interest rates that we're seeing right now. So there's really a disproportionate destruction of wealth that's going to happen as these interest rates climb.
A disproportionate destruction of wealth, and it's coming soon. All right, Michael, let's turn it over to you. First of all, tell us a little bit about Momentum Structural Analysis and your method.
It requires a little bit of patience on the part of your audience because I'm going to bore them just a little bit, but I think there's an aha moment in this boredom. I have to explain our methodology because we're not, when I say technical analysis, most people leap to the conclusion that we look at price charts and draw lines on them. We don't. We do look at price charts, but we look primarily at momentum of price, and we measure it in different ways than most people measure momentum. We've done this since 1992. One of the basic concepts that undercuts fundamental analysis and undercuts orthodox technical analysis is the assumption that they're measuring something. And by measuring something, you have to have a unit of measurement. Like if you're building a building, you've got a yardstick or you've got a level or whatever. These are objective tools of measurement. Therefore, the building, when you build it, the unit of measurement does not change on you month to month, year to year. So you're building, by the time it takes 6 months to build a high rise, let's say, the units of measurement did not change month by month, and therefore you have a building that would collapse on itself. The yardstick stayed 36 inches. Similarly, if you have a thermometer in your bathroom to measure your temperature, it says 98.6 is normal. And if you have a fever of 103, but you go in a month later and use the thermometer and it still says 98.6, you change, but the thermometer actually changed because it's not registering the proper temperature. So you have to have units of measurement that are objective and that stay firm, so you can count upon their authenticity, right. Make correct decisions. Well, when fundamentalists measure year-over-year sales at Macy's, they're measuring dollar sales, or if they're in Europe, they're measuring it in euros or yen in Japan. Well, those units of measurement change dramatically in terms of the quantity of the units of measurement. The water level in the swimming pool doubles every 10 years. So if I own a stock at $30 10 years ago and it's at 30 now, I'm not winning. I'm not break even. I'm way down because the number of units of measurement that I'm still using have doubled in quantity in the past 10 years. And you can see this by going to the Federal Reserve of St. Louis site and asking for M2 chart going back to 1960. Every decade it doubles. So there's a fundamental flaw in the unit of measurement used by both orthodox technicians and fundamental analysts, which undercuts the validity of their analysis. Some of them try to back this out by using deflators or using some government-issued CPI, which is hardly compensates for the distortion of the unit of measurement. So how do you get around that? How do you, frankly, you can't ultimately get around it. So what we do is this. There was a famous technician at Merrill Lynch back in the 70s, a guy named Bob Farrell. Many of you know his name. He came up with 10 rules of investing, and his first rule was markets always return to the mean. Well, by a mean, of course, he meant an average, usually a long-term average, but we can measure markets by short-term averages, 10-day average, 50-day, 100-day, 200-day, 3-year, so forth. You can measure market by various means, various averages, whether you want to get a long-term view of the market or a short-term, depends on which unit of measure, which mean you refer to. To some extent, this assists in objectifying the unit of measurement, the dollar, the euro. It doesn't get rid of it entirely, but at least it gives you another reference point, which is the change over time of the mean. And markets do indeed oscillate around their mean. They don't merely return to a mean. Often a market will oscillate on the other side of a mean. So it'll drop back to its 3-year average sometimes and hold there, and sometimes it'll go below it by as much as it's been above it. Therefore, it oscillates the mean. You can measure this, and you don't do it by overlaying a moving average on a price chart and viewing it as a crossover situation, which is the way most people use moving averages. What we do is we plot price in its relationship to that mean. Hence, we create an oscillator. That's our primary tool. We include price charts in our reports to show the contrast, and in fact, I can do that in our talk today to show your viewers the difference between what they see when they look at a price chart and when you look at a momentum chart. But that's, in essence, the revolution that we are personifying at MSA, is that we don't trust price charts at face value. Breakouts on price charts might be 60-40 accurate in terms of indicating a change in trend. We think we're more like 80-90% accurate when we use momentum. It's far better use of price. So if I've got a few visual examples. The first one is back in 2014, which was a situation that caught most analysts by total surprise. It did not catch us by surprise, and that was the collapse in the price of oil. And the charts that you're looking at show price action of oil from 2010 through late 2015. Top chart is a price chart, which is what most people are used to looking at, and it shows each monthly close, so it's a monthly close-only price chart. And as you can see, between 2011 and 2014, there was a slight upward drift in the price action. And it wasn't negative at all. You look at the chart and say, hey, this is fine. I'm making slightly higher highs and I'm making higher lows. Therefore, it's bullish, correct? Well, when you convert it to a momentum chart by plotting that same price in its relationship to the rising 3-year average, you can see a totally different vista of what oil was doing during 2011, 12, 13, and 14. It kept coming back down to a flat structure at the zero line. Namely, it kept retreating back to the 3-year average. And on momentum, it looked like a descending triangle type pattern. Did not look at all like the price chart, which looked happy. And in August of 2014, at a price at $96 a barrel, a very high price still, price was not breaking below anything significant at that point, but momentum was blowing out a floor that was 4 years wide. And so if the bottom chart, which is the momentum chart, were a price chart, you'd look at it and run screaming from the room. You'd definitely be out of oil. And momentum warned. Well, within several months, oil collapsed big time. The warning came from momentum. You could see it setting up for months prior to the downside breakout. So that's one visual picture that shows the difference between the obviousness of price, which is often misleading, and measuring price against a mean, in this case an annual mean. Let's go to a market that's more current now, and that's the gold situation. Back in the chart on the top is a monthly bar chart of gold, starting in 2009, going through early 2016. So the chart is not up to date. It's a few months behind. Gold is $100 or so higher than that chart now shows. But the price chart in 2011, of course, we peaked above 1900. Looked great. Momentum also at that point, as you can see on the chart below, was rising as well. So both charts were happy. However, in the opening of 2012, momentum broke a very clear set of structures, uptrend line and a flat line. Price didn't break anything. It just dropped down and held and rallied back up again. And for a period of about a year there, price was stable below the high, up and down in a trading range. And most gold bulls at the time, and I'm fundamentally a gold bull, but I was technically a gold bear at that point because of our work, was happy. It looked like, well, maybe this is a trading range prior to another launch, a whole new bull leg. That would be your rationale if you looked at the price chart. But when you looked at momentum, you could see it was already broken, and it kept bleeding. Every month, the momentum readings were dropping and dropping. Finally, in 2013, early in the year, the collapse really began. So the momentum observer, plotting as we do here against this annual mean, could see that something was wrong, and 1 year before the total collapse in the market. In a period from about March through June, gold gave up, dropped from $1,600 down to under $1,200 an ounce. So basically, the entire bear market occurred in about 3 months. Then we have the situation where gold continued to decline from the summer low of 2013, when it broke under 1,200 intra-month, to a low in late 2015. So if you're looking at the price chart, you see nothing but a downward staircase. It's not a collapse. I mean, you only lost another $100 in that 2-year period, measuring from the summer low of 2013 to the low in late 2015. But it still wore you out if you were a would-be gold bull. You just kept seeing lower lows. You finally just gave up emotionally, as most gold bulls did. But if you looked at the momentum chart, it ceased to go down after the 2013 low and instead built a flat ceiling above itself. Not lower highs, but flat highs. So if you were looking at the momentum chart, you would say, my goodness, this looks like a potential bottom. And sure enough, it was. Well, in February of this year, when gold moved up to about 1140 to 1150 area, it broke out above the top of that massive couple-year wide base. So it was a big base. It was a clear base. But it was only big and clear on momentum, not on price. Price was still in a descending pattern. In fact, the price chart didn't really break out until you got up into the mid-1200s. So momentum both warned you ahead of time, and two, gave you a specific entry point, as again, that was 1140 to 1150, where it broke out. And so since then, the market has done nothing but rise and shelf and rise and then shelf again, but continue to advance. But it was clearly warned by momentum. So that's a chart to keep in mind now, because that is a massive gold base that we've just emerged from a handful of months ago. That base is so big that it is not meant to produce a 3-month rally. That base is a major trend change signal when it came out of that base. So we're quite bullish on gold now, opposite of our position in 2011 and 12, which was bearish based on momentum. I think gold has begun an entirely new bull market, and we're early in that bull market, and it has a long way to go. In fact, our opinion is you won't get major resistance until we get up either side of 1,500 before you encounter your first significant resistance, and I don't think that'll stop it ultimately either.
Okay.
That's a market to keep in mind, though, because gold is saying something there.
Right, and it's saying something in stark contrast to what the Fed and the ECB wants it to say. They don't want gold running. I think, and you can correct me if I'm wrong, but I think the manipulators have lost control of these markets as China and other nation states turn to physical, the foundation of the SGE in China. Of course, David and I have talked about that at length. But, let's circle back now and talk about the bond market blow-off phase. Because if in the 80s, the introduction of these unallocated gold and silver contracts short-circuited the bond market, as David told us in the last interview, and now we're approaching the bond market blow-off phase, this will be the popping of the world's biggest bubble. What is that going to mean for people? What is it going to mean for the economy? And what is it going to mean for the future of the United States if the bond market blows up?
Well, you're asking me a fundamental question, and I can give you an answer, but I think David would do a better job at that, and I'd like him to address that in a few minutes. But I'm gonna just play the cold technician, if you don't mind.
Please.
And you mentioned the word blow off, and you need to explain that. We need to explain that to your listeners. A blow off is a situation in which a bull market that's aged, been going up for years, and certainly the bond market has, suddenly decides to, instead of go up at the prior angle of ascent. And if you look at the bond chart that I've provided you here, the top chart is a monthly bar chart of T-bonds going back to 2013. 2003. It goes back 13 years. It's T-bond futures. And you can see there's a line across the highs that basically every high since then, up until recently, has stopped at that angle of ascent and said, okay, that's enough for now, backed off, come back up again. But in about 3 or 4 months ago, T-bonds closed over 170. This is futures, closed over the price of 170, shot up to 177 pretty quickly the next month. It was last month. All that action is out above that line. It's a temper tantrum. It's a blow off. It's like a pressure cooker lid coming off. It's saying that demand is so aggressive now that we're just going to leave the earth. Well, markets never leave the earth for the long run.
Sorry,
By
that
the
was
way,
the sorry, Michael. That was the 10-year that you're using as your
no, we're
benchmark.
using a 30-year T-bonds.
30-year, okay.
This is
market.
T-bond futures, which are 30-year.
Yeah, and you're saying markets always return to the mean, right? So we're not leaving planet Earth just yet.
No, we're not going to leave planet Earth. And the mean in this case I'm using is a 36-month average, which is a smooth 3-year average.
Right.
And you can see it overlaid on the price chart. At its lows, the T-bonds will almost always go back to the mean and drop 3 or 4 5% below that 36-month and go up. So crossing the mean is not the issue here. But it is a unit of measurement against which we can oscillate the price action, measure where, for example, is this month's high and low in price compared to that average. And then we plot that on the oscillator, which is the chart below the price chart. And you can see that since 2013, which the bonds were going down from 2012 through 2013, meaning rates were rising. Most bond analysts at that point, including PIMCO, for example, were bearish on bonds, thought rates were on their way up. We got bullish on bonds in early 2014 because of quarterly momentum, which told us it was going up. That chart is not shown here. But from that point forward, so it's 2.5 years now, an uptrend has developed in T-bonds. You can see it on the price chart, and it includes the blow-off phase, which is circled on the top price chart, where we exceeded the roof, so to speak. The elevator came through the top of the building. Okay, is another visual picture. Momentum built a nice trend line as well. The price. Now, if you look at the price chart and you draw that line, and it incorporates quite a few lows going back 2.5 years, it will break down if T-bonds drop below about 160, which is about 10 or 11 points below where the market is right now. But if you plot the momentum chart, it adjusts upward monthly too, as does the 36-month average, which is the mean against which we measure the bond price. It's going to break down about 5 or 6 points above the 160 level. So around 165 to 166, quite a bit higher than where the price chart breaks down. Momentum is going to break a major uptrend line. Now, after having produced a blow-off phase, for a market to turn down is usually devastating because it's had a tantrum. It's exhausted itself so badly that when it turns down, it's likely to find few buyers. It has sucked all the buyers off the page, and it turns down, it will find an absence of bidding until a deep level. And I'm going to suggest that that deep level is between 135 and 140, which is quite a distance below the current market. That would equate to seeing price down around a yield, at 4% or higher. Right now, long-term bonds are yielding about 2.25%. That's quite a jump in yield. So what we're trying to measure right now at MSA is the violation of this long-term momentum trend line that's plotted on the momentum chart. That breaks it right now at about 165, next month about 166, just up each month about a point. We'll also measure T-bonds via more intermediate trend metrics, like a 3-month average, or and so forth. So we also look at it closer up, and we'll have more nearby signals that indicate a selling process has begun. But anyway, this is the big picture, and it is ugly. And the primary reason it's ugly is the bonds had the temerity to produce the blow-off. Now, if you saw the JGB, the Japanese government bond, it has been in blow-off for 6 months. So it's even more egregious. And it has now started down. The JGB has already started to break. It has not yet broken its annual momentum structure, which is around 150, 151 level, but it's trading just above 151 right now. So it's very close to breaking its annual momentum trend. And I lump together, by the way, the T-bonds in the U.S., the German Bund, and the JGBs. They all look equally vulnerable for a coincident sharp rise in rates, drop in price. Another factor that we need to look at is, well, if rates are going up, where's the money going to go? If the bond market is flushing itself out, if the stock market is going to be a victim of this, which it likely will be, where is it going? Well, we've already seen that gold turned up, and gold is usually a leader of commodities. It certainly was back in the late 70s by about a year. The next chart is the Bloomberg Commodity Index, and I do the same thing here. We have on the top of the page is the monthly price chart of the Bloomberg Commodity Index, which is a very representative sampling of the commodity asset category because they don't heavily weight energy in relation to the other commodities. Like, for instance, the Goldman Sachs Commodity Index is very heavily weighted to energy and slights gold, corn, and things like that, for example. The momentum chart of the Bloomberg Commodity Index has a massively clear downtrend structure that is not equally clear on the price chart, and we are there right now. The Bloomberg Commodity Index is trading right now at about 86 points. If you close out this month much above 87, that trend line that goes back to 2008 is a 4-point downtrend line of momentum. It will break out. And if you break the commodity index out, coincident with the bond market breaking down, that is a statement that makes sense. It says that we're about to have commodity price inflation. The liquidity created by the central banks, instead of going into stocks as it has been, is shifting. The river of flow is shifting into commodities, and gold has already told us that.
Yeah. Sorry, Mike, but that's an important thing because the monetary inflation created by the central banks, the definition of inflation is an increase in the money stock. It has been parked, and that's an Austrian and a classical definition of inflation. The monetary inflation has been parked in the bond market. And what we're seeing now is that the global debt market and bond market, which is over $200 trillion, it just needs to give up a portion of that money and to go into consumer goods to cause highly accelerating consumer goods costs, rising cost of living elements that people depend on, and then push up the interest rates, popping the bubbles that we've had created around us.
Yeah, I just wrote that down as Michael was talking, cost of living. You've just painted the picture for inflation and potentially hyperinflation.
Right.
The things that people need to live are going to go up in price as this bond market bubble pops, and it's very scary. Of course, you guys know that we follow the work of John Williams, who I think, like Michael, to at least some extent, likes to try to use real figures and real accounting statistics to figure out, for instance, the real-world price of silver using M1, M2, M3 money printing. John Williams figures that the price of silver today should be closer to $650 an ounce based on all the printing that's occurred. And when this bond market blows and that money comes into the real world, it's going to devastate all Americans. I think it's going to devastate everyone around the world, and I don't want to paint too bleak a picture, but my God, guys, look what's going on in Venezuela right now. Could it get that bad here, David?
Well, the bond market is globally large enough, and the commodity space is so tiny in comparison that you reallocate wealth from one to the other, and you can absolutely send prices much higher, much more quickly. One other point, Sean, to buttress Mike's point there in terms of incipient breakout in the bond market is if we look at the LIBOR, which is the London Interbank Offered Rate, and that's what the banks charge each other in London for lending money, and it's a global interest rate benchmark. It has been increasing since the end of 2014, and it started to run quite intensely now, jumping. I think on the 12-month measurement, it's up about 20%. It's run from about 1.2% to over 1.5% now, basically since the end of 2015. We're seeing that the 12 and the 6-month LIBOR rate running now and accelerating to the upside. And why that matters is that there's Zero Hedge had an interesting article that noted that this is a reference point for $28 trillion of debt. It sets the interest rate for $28 trillion of global debt. Mm-hmm. And so we are living through the end phase of a global credit bubble, which has been created by short-circuiting the gold and silver markets, forcing interest rates down in a secular manner over 35, 40 years. And what we're seeing now is that the $28 trillion of global debt, which references the LIBOR rate, that debt market is experiencing a tightening, and now a strong tightening. So when you have credit tightening in a credit bubble, you have the recipe for the bubble collapse, and that's what we're heading into now. And I think that what Michael is seeing there is for the support of that, is that now we're seeing it move into the government debt markets, which these are tier one measures of debt, and even they now are showing signs of an incipient increase. So it has real meaning for people globally. And I think now that seeing this gold and silver start to move up, I would note, though, one thing is that the gold and silver moves, in my view, here are highly muted. Because they are trading a couple 100 million ounces of gold every day, which we know is unbacked. These are the unallocated contracts which were created in the late 1980s in London. And they are trading these, and the volumes are increasing. We're seeing silver now that the trading volume is running at levels which were seen in 1 month in 2014, and before that back to 2011 when silver was around $50 an ounce. So we're seeing rapidly increasing trading volumes and increases. We can see in the commodities exchange in New York, in the COMEX, that the open interest now is at record levels in silver and near record levels in gold on the commercial side. So in terms of the short positions that they have. So, the price action is indeed breaking out, and we are seeing the price of gold and silver start to move up. But a number of things have happened really to hide the actual price action. And one other thing I would note is that while gold has been dropping in price since 2011 through to the end of last year, is that the World Gold Council and Thomson Reuters GFMS were understating the actual level of Chinese gold demand by $30 to $45 million per year. And David Jensen, in his work there at Bullion Star, does a very detailed job at showing that, in that they were, the price was falling. We were being told by the World Gold Council that gold was in a kind of a blah state, and then meanwhile we had a stunning offtake of over 2,000 tons per year, which is 2/3 of global gold mine supply being poured into China. So the gold price is indeed breaking out, but it's nowhere near what it would be breaking out, the levels it would be breaking out to, if you're actually trading the actual metal.
Well, I agree, and let me just jump in and say that despite what the World Gold Council and the GFMS has been saying, you know what they can't hide? They can't hide the momentum that we've been seeing in the gold and silver mining stocks space. I just interviewed my buddy PulseScan72 from YouTube, who noted that he doesn't know if he's ever seen charts as powerful as what we've been seeing, guys. They can't hide the worldwide appetite for precious metals in the mining stocks. So I should ask you, Michael, what do you make of the powerful momentum we've been seeing in these mining stocks year to date?
Well, late last year, before gold turned, in February of this year when it broke out, we studied the spread relationship between XAU index, which has long been around as an index of gold stocks, and GDX, which is a unlevered gold mining ETF, against gold, and they've been in a downtrend versus gold in terms of performance for a decade. So most gold bugs who had gold mining shares in the portfolio were very disillusioned, very hurt, worn out, tired, bleached. Okay. Yeah. The spread said, nope, it's changing. This time you don't want to own gold in the next upturn. You want to use gold as your barometer, but you want to buy the gold miners. Yeah. And sure enough, even GDX, which is the more stable, bigger name gold stocks, it's up 125% on the year. Gold's up 27.
Well, in the GDXJ, the juniors have done even better.
Yes.
I mean, it's
Yeah.
just it's astounding. And my point here, and I've been making this point in interviews recently, is this momentum, this deep-heeled, deep-pocketed Wall Street money. These are the people buying the mining stocks, and it's telling us a very, very important story. I think that a lot of this money, David, you and I talked about this last time. You said that
Yeah.
it's possible that gold and silver mining stocks may provide a ballast to what otherwise would be a completely collapsing stock market and bond market.
Yeah,
And
it's an asset on the balance sheet which can act as a life preserver.
yeah, but the point here is that I want to make is that we might see these things go, well, in Paul Scan 72's estimation, 1,000% higher, and he thought he might be lowballing it.
Yeah, it's interesting, Sean, because Coeur d'Alene, which has the symbol CDE, Charlie Delta Echo, it's gone up 904. It's at 940%, pardon me, of the mid-January price, which was the low. So the Coeur d'Alene alone has already gone up close to 1,000, or is at 1,000% of what it was back in January. So, and the other thing that I find of interest is that the relative strength indicator, which is some people follow that, the classic technical chart followers follow that, but it has never gone over 75% in this whole time. So it's not showing any kind of bubble behavior, and no sign of mad speculation and the blow off, which you would expect with that kind of a price move. And the other thing that I find of interest is that silver is in the ballpark of $20 US an ounce right now. Well, back in 2014, the last time it was at that price level, both Coeur d'Alene and Hecla, which has the symbol HL, both of those stocks were trading at half the price level that they're at right now. So it looks like indeed something is changing fundamentally, and that there's pouring into these money is pouring into these equities, and there's such small spaces that it's not even that much money that's gone in, but we're seeing basically a sea change, and the money is starting to pour into these assets. And I can see why it would, and not into spot claims in London, given the fact that the excellent work that Bullion Star did, as well, was tracking all of the vault gold in London, showing that they were down to basically zero gold in the commercial vaults in London outside of the Bank of England, and the gold held by the ETFs, exchange traded funds. So that gold is spoken for, and I can see why money would be starting to pour into equities, as there's the realization that if you're going to hold paper, you might as well hold paper that owns something.
Right.
And certainly holding a spot market claim, an unallocated spot market claim in London really gives you nothing. And that really is, Jacob Rothschild came out a couple of days ago and said we're living through the greatest monetary experiment in history. Well, I mean, the Rothschilds ran the London gold market from 1919 to 2004.
That's right.
And really the greatest experiment in history was creating unallocated gold contracts and then trading hundreds of millions of ounces of those and billions of ounces of silver per day, unhinging the global debt markets. That is the greatest monetary experiment in history. And the banks now are scrambling, and we're hearing Mark Carney there at the Bank of England talking about Brexit being cause for this malaise that we're seeing, and certainly he's following the LIBOR charts, but these have been running since the end of 2014. There's something else going on here, and I think it's a move into things that you can't print, because the insanity, it's very difficult to find the right noun to describe it, but it's really a form of insanity of the central banks, in terms of saying, well, we have a debt bubble and the debt bubble's collapsed, and instead of cleaning up the debt markets and writing down the debt, they prescribe more debt. And we have a monetary system now that doesn't use gold or silver as units of currency, but we have units of debt now that are our money. The money that's in our wallet or on our cards are units of debt. They're created by banks, the debt created by banks, and it's the debt created by governments. So that is the monetary experiment. It started in 1913. And then gold was basically separated from the pricing structure in the late 1980s. And now we have the highly predictable result, which is a bond market collapse. And ultimately, it's going to create instability in the financial markets and ultimately undermine our currencies. And that's how they, Sean, you referred to the Economist cover there in 1988.
That's right.
Saying that we were due for a new currency in 2018. And that's how they would know that we would have a new currency, is when you decouple gold from the financial system, from the monetary system, you can create these units of exchange without end, without limit. And in the end, they collapse, and then you know that you have to return to a sound money system thereafter.
Yeah, it's the 1988 cover. The Rothschilds owned Economist magazine. Get ready for a world currency, and here we sit, just what, 18, 17 months away from 2018. Funny how prescient and omniscient these international criminal banksters are to have predicted such a thing. And here we sit. You guys have essentially just described the collapse. As we document the collapse at sgtreport.com with really trusted analysts, you guys know the names. I think that we here on this interview have done maybe the best job that we've ever done documenting the collapse of what's to come. And I just want to say one more thing, guys, as it relates to these mining stocks. Willem Middelkoop, who has been in China, has boots on the ground, has been at these conferences in which the Chinese are talking about backing the yuan, moving away from the dollar permanently, and they want to be part of whatever this next currency or next monetary system is. They want to be a big part of it. Willem Middelkoop has noted that fund managers like him, pension fund managers, are disallowed from buying physical precious metals. So as these guys, these fund managers start to panic, as this bond market bubble starts to pop, where is that money going to go? We've already seen where it's going. Just small little slivers of it have sent some of these mining stocks 1,000% higher. And it's just stunning. I think what is going to come, well, it's going to be a shift of wealth. I think as Mike Maloney has best described it. And there's an opportunity for our listeners to A, not get crushed by this collapse, and B, potentially profit from it. And I am not telling anyone, I don't make any investment advice. I don't tell people, this is not a solicitation to buy or sell anything. People know who listen to this show that I believe in physical precious metals. But guys, the physical precious metals, silver and gold, have been held down. Silver and gold in physical form should be trading much, much higher in U.S. dollars than they're trading right now. And the proof of that is the mining stocks. I mean, the mining stocks are behaving how physical silver and gold should be behaving.
Yeah, and China is really putting an end to the paper market with the Shanghai Gold Exchange, where you can't trade actual bullion, gold or silver bars without depositing a bar first. And especially for the silver market, where you've got claims in London which are four to six times known global stockpiles that are already owned by other people. China is essentially creating, if you want to talk about Chinese water torture, well, this is Chinese silver torture. They drip, drip, drip. They continue to trade the metal and show a price premium. It's running about 60 cents right now. And that's enough to bring, there's a very small amount of silver which is traded in Shanghai. It's only about 20 million ounces a year, which is tiny versus the global market of about 1 billion ounces of actual metal a year. But what they're showing there is that price differential is enough to draw silver into that market through the black market and other venues. And when you're seeing that China trades several hundred million or uses several hundred million ounces of silver a year and produces a couple hundred million ounces more, to see that price differential in a market which is already flooded in silver production. And knowing that you're drawing silver into that country, it costs less than a nickel to move it per ounce into that market. It's telling us something. And one final point here, Sean, is that Michael's work showing this increase in interest rates, the people that are holding bonds are so vulnerable right now. Just to give them a sense, is the Zero Hedge article, which noted that a 1% rise in the 10-year, you'd lose 8.7% of the value of a U.S. 10-year Treasury bond. And you'd lose 19% of a 30-year Treasury bond. That's just with a 1% move.
Right.
So you can imagine these pension funds and insurance companies and the banks that are holding these assets as the banks are holding them as Tier 1 capital, determining their leverage ratios. But you can wipe out the pension funds, which are already eating into their principal now just to make their annuity payments.
I was just going to mention that. We're seeing terrible news out of CalPERS, which I think is the largest pension fund in the nation. Yep. It's these negative interest rates. You described it best. The Federal Reserve, in this systematic insanity that they've targeted the population with through these negative interest rates and these zero interest rates and these maniacal policies.
Right.
Andy Hoffman would disagree with me about this. He would say these people are just idiots and they don't know what they're doing. I take the opposite approach. I think that they knew very well what they were doing. And again, look at that 1988 cover of the Rothschild magazine. You can't. It's hard for anyone to convince me that this wasn't all by design.
Yeah, it's very, very unfortunate what is happening here, and what we're seeing now is this baiting of Putin that's going on. A couple of days ago, the U.S. moved nuclear missiles from Turkey into Romania, very close to the Russian border. Mm-hmm. We had that issue back in the 1960s with Cuba, and we saw how the United States responded.
Right. No, the Joint Chiefs wanted to go to nuclear war with Russia, and
right.
Thank God that John F. Kennedy had the presence of mind to get on the phone and call Khrushchev and say, "Hey, calmer minds need to prevail here," and
right.
They saved us from nuclear destruction. Those two men,
so
because the Joint Chiefs wanted nuclear war, and I think that there's powers that be in control now that want nuclear war. You're right about this. NATO in this government is rattling the cage, and Putin recently said, "I don't know how to get through to you people." You know, he told reporters, Western reporters, you need to tell your citizenry what's going on. Report the truth, because we are headed down a path that is irreversible.
Yeah, I think we can see why it's happening is that you create a bigger problem than the problem that you have. And instead of us addressing our issues, scaring people, trying to keep them in the bonds as the safe asset and starting an outside conflict as a distraction, is not dealing with the issue itself. The real issue here is that our debt-based money system is failing, and what John Exter called power money is asserting itself again. Surprise, surprise, it was chosen by the markets over 4,000 years. And here we have these monetary assets again asserting themselves, and as the age of paper money and debt-based paper money comes to an end.
All right, you know what, guys? I'm getting goosebumps here because I really do think this was one of the most powerful interviews, and so my thanks to both of you for participating in this conversation. And let's leave the audience with this. First you, Michael. How does this end, in your view, and how quickly does it end?
I think to some extent I like chaos theory and things that go linear incrementally as markets tend to. When they come unraveled, they resolve quickly. Like 2008 collapse in the stock market, for example. In other words, the excesses that preceded that came undone rapidly.
On Thursday at about 11 o'clock in the morning, the Federal Reserve noticed a tremendous drawdown of money market accounts in the United States to the tune of $550 billion was being drawn out in a matter of an hour or two. The Treasury opened up its window to help. They pumped $105 billion in the system and quickly realized that they could not stem the tide. We were having an electronic run on the banks. They decided to close the operation, close down the money accounts, and announce a guarantee of $250,000 per account so there wouldn't be further panic out there. And that's what actually happened.
Of the tech bubble. Years of up, gone in months, that type of thing. Well, in this case, what we're talking about is a reversion to a better situation. In other words, a recognition of gold-backed currencies. And of all places it's coming from, you would never have guessed ex-communist powers, Putin and China as advocates of gold-backed currencies.
Right.
So talk about chaos theory, coming up with all outcomes that you would never expect. But I think ultimately the instability will lead to rationality. And the people who have been critics of this entire process, the Austrian School of Economics, for example, the Mises Institute, to some extent, maybe the Cato Institute, these type of intellectuals, their ideas will rise in their acceptance by a wider audience and will help direct the political direction of various countries, including, we're having a revolution now in Europe to some extent. It reflects some of the rise of these political parties, reflects some of the things we're talking about today, because many of these political parties, including the Brexit voters, were anti-EU, anti-centralization of the state. They were for fragmenting the state. And I think anything that fragments, even something as bad as these market events will be, will induce fragmentation of the size of governments back to smaller, and smaller. And the more you do that, the more freedom you have.
Absolutely.
So I think it's a super event. It's a kind of event to applaud, and I don't think it takes long to resolve.
All right. Well, I will say this before we turn it back over to David for the last word. If people want more of the same, if people want to go to war with Putin, if people want to see more of this globalist agenda carried out, then vote for Hillary Rotten Clinton. If you want to see anything other than that, then don't vote for that woman. My God, I've said before in interviews, guys, she is literally Rothschild's choice. They held a $100,000 per head fundraiser for that woman not long ago. She literally is the bankster's choice to their puppet to be in the White House. All right, last word from you, David. How does this all end? I think it's going to end very, very badly.
Yeah, it's the the escalator up and the elevator down in terms of what's going to happen to the markets. But my one of my greatest concerns is that the central planners at the central banks and in the government, who are really the authors of our demise here, now have a plan for digital, centrally controlled money, digital money, and trading carbon credits. This is their latest scheme, and what we need to do is get rid of the central planning, and instead of that, now we have calls for greater central planning. The Bank of England is pushing this carbon credit trading. It's insane, and pushing digital money, centrally controlled money, where basically takes away the ability of individuals of the market really to function in any kind of coherent manner. The price setting mechanism of the market it brings the rigor and brings production into alignment with demand, and digitally traded or created money and central planning of interest rates means that we won't have a recovery, and that we'll live in continued squalor, or increasing squalor really. And that's the problem that I'm concerned about going forward, is that we don't break free of central planning, and that they just double down on stupidity.
Yeah, my concern as well. I've always said that I'm afraid they're going to turn the vast majority of this population into serfs. The only way to protect yourself, guys, is with physical precious metals. And as I've been advocating more recently, you may want to consider some of the best gold and silver mining stocks as a hedge, as a way to have an extra rocket blast as these things continue to move higher. Again, as these pension funds and other Wall Street money start to panic, there's only so many places they can go, guys, and there's only so much allocated physical metal left on Earth. So I guess the critical mind would at least want to consider the mining stocks. Guys, I told you this would be a powerful interview, and it sure was. I really appreciate you guys coming on. David Jensen, of course, your work is found at safehaven.com and at SGT Report and around the internet. And Michael Oliver, you're over at olivermsa.com. Please tell people briefly how they might be able to take advantage of some of your reports.
Well, as far as MSA, if you go to the site, you can click on a tab for samples, and I'd be happy to send you some sample reports so you can see the type of work we do in across asset categories. We don't just look at stocks. We look at the foreign exchange markets, the debt markets, and the commodity markets. So there's hardly anything we don't examine.
Yeah. Well, two of the brightest minds I think that I've ever had on the show. And David, did I skip anybody else? Who else carries your important work?
Safehaven.com, 24-hour gold over in Europe, Gold Eagle. So it's starting to be posted much more widely now. But thanks for that, Sean.
Yeah, it's all my pleasure. Thanks for coming on, guys. I really do appreciate it. And for listeners, thanks so much for sticking with us. If you liked this information, please do hit the like button and share it with your friends, neighbors, and colleagues. What we have just described, guys, in this interview is the collapse, how it's going to happen. And both of these gentlemen think it's coming very, very soon. So thanks for listening, and thanks for checking us out at sgtreport.com, thelibertymill.com, and thephaser.com. Real news 24/7. God bless. Have a great week.